We coined the phrase, the time has come, in the publication. And really, it's an acknowledgement that with the Fed starting to reduce rates, some uptick in transaction activity, and the sentiment that I just talked about, the feedback we got both from the survey and from the interviews that we do was that we're at the outset of a new cycle.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. Today I'm speaking with Andrew Alperstein, real estate partner at PwC, about some of the main themes from the PwC and ULI America's Emerging Trends in Real Estate 2025 report. Andrew, welcome back to the podcast.
Sarah, thanks for having us again.
Andrew, to start off, overall, how would you describe sentiment towards CRE that really underlies your 2025 outlook?
Sure. We were pleasantly surprised and pleased to see an improvement in sentiment as we looked at our 2025 publication relative to 2024 and 2023. We had seen through our surveys and interviews qualitatively certainly more optimism around the sector as we were heading towards 2025, and manifested itself in some of the sentiment surveying that we do and that we show in the publication. So we were pleased to see that, particularly given we've had a challenging couple of years with higher interest rates and really a lack of transaction activity. So yeah, sentiment definitely improved. I would just add, Sarah, that when we look at the survey respondents, while the sentiment had improved relative to 2023 and 2024, we're still not at levels that we've seen previously in terms of the positivity of that sentiment. So we're hovering around 2017 levels. And so the beauty of the publication is we get to track this over time and see how the respondees' sentiment changes. But no question, an improvement in sentiment year over year.
Would you say that there's a central theme to the report, and how does it differ from what you've seen in other years?
We coined the phrase, the time has come, in the publication. And really, it's an acknowledgement that with the Fed starting to reduce rates, some uptick in transaction activity, and the sentiment that I just talked about, the feedback we got both from the survey and from the interviews that we do was that we're at the outset of a new cycle. And so we coined this phrase, the time has come, as we enter into this new cycle that will hopefully bring us increased activity and momentum as we head into 2025.
And to what extent is the interest rate landscape still shaping sentiment?
Certainly, it's a huge influence. When we do the majority of the interviews and surveys, it's in the July, August, September timeframe. At that time, the 10-year Treasury was in the mid to high 3% range. We've obviously seen a bit of an uptick since then. And when you think about the impact of the 10-year Treasury on borrowing rates and then on yields and cap rates, there's no question that is an input or a factor that is being watched so closely. And the volatility with which particularly the 10-year has moved around as the market reacts to economic news has made it hard for market participants to get comfortable with underwriting, with decision-making. And so I do think that the interest rate environment forms a very important piece of the momentum that we hope to see going into next year. And one of the big themes we heard from folks in the marketplace is we need more stability in borrowing rates and in the 10-year Treasury so that we can make those decisions. Huge impact, and we've obviously seen that volatility in recent weeks, and it is something to watch really closely as we head into the new year.
And what impact is that likely to have on transaction activity in 2025?
There's no question that as the Fed acknowledged their rate cuts, and we'd seen the 10-year and borrowing rates decreasing over 2024. There was an increase in comfort level in valuations and pricing, and that was creating a catalyst for an increase in transaction activity, particularly for the more desirable property types, multifamily and industrial particularly. As we see the 10-year notch up a little bit and borrowing rates likely notch up a little bit, that's something we're watching closely as to whether we'll see adjustments in valuations and adjustments in pricing and what that will do from a transaction volume and activity perspective. So that's going to be a really important factor as we head into the new year.
Right. And according to your report, data centers currently really dominate the real estate market. How do you see the supply-demand balance shaping up here?
Really positive momentum in that subsector, Sarah. The demand drivers there are hard to ignore when you think about the increasing need for capacity and data center space, not just in the US, but globally. So a lot of conversation and a lot of positive sentiment about that subsector. Some of the challenges, transparently, are going to be where does that new supply come from, given it is a more challenging property type to get entitled, get power connected, get developed, identify tenants. And so we're kind of watching closely that dynamic of whether, when, where, and whether the new supply will come online to meet the significant demand that is in the space. The other interesting piece to the data centers is just how costly, how valuable some of these data centers are relative to other property types. And that will be another factor that will likely limit the number of players in that sector. And that's what we've seen in the industry, is that there is some concentration in those that are active in the sector. But this is a really unprecedented property type, just given the tailwinds around data, Gen AI, and the like, and something that I'm sure we're going to be focused on in the publication in the years to come, just given that it is very much an evolving property type.
Andrew, another interesting sector is office. With these new return to office mandates emerging, do you think the sector is likely to take a more positive turn ahead?
It's interesting because I think the sentiment is still, I would say, largely negative, but with some very clear outliers on the positive side. And we've seen particularly parts of Manhattan really bounce back from a occupancy, rent, and demand perspective. It tends to be the better quality assets, better amenitized, better located, that are driving a lot of that demand. It's not in every CBD, it's not in every submarket of CBD, but there are assets really performing well in the office sector. The challenge, obviously, is that you've got a lot of office product that is likely obsolete, would require significant capital to reposition. And while we are seeing some conversions, it's not yet at a scale that's not biting very much into the obsolete level of inventory. So the sentiment is still relatively negative, but I think with an acknowledgement that there are certainly some positive signs coming through, particularly, as I said, in places like Midtown Manhattan and a few others. But this is another area that's going to take quite a period of time to work through. And let's not forget, there's almost no new supply coming online in the office space. While the sentiment is negative, there are going to be opportunities for folks to either buy in at very low levels or to reposition, whether it's apartments or other property types. And so I think there's going to be some opportunities and money made, just given some of the distress and dislocation that exists for certain assets.
Did any other sectors stand out particularly in your report?
You'll see that we highlighted retail, we highlighted senior living, and so let me maybe touch on those two. I think that the retail story is a positive one. For a number of years, retail has been somewhat tainted with some of the challenges that particularly the big box mall product experienced over the last 10 or so years. But we're seeing an environment now where retail vacancies are at very low levels. We're seeing good rent growth. We're seeing good demand for space. And so there's a renewed acceptance in the market around retail as a property type that should be part of an allocation strategy. So it has been encouraging to see the bounce back in retail, and we do expect retail to be one of the better property types as we head into 2025. I mentioned senior living as well, and one of the themes in the publication was around affordability, both on the traditional multifamily side as well as senior living. And if you look at the demographic trends and the aging of particularly the US population, there is almost certainly a shortage of supply, particularly in the middle market space of senior living. Most of the new supply that's happening in the senior living space is at the higher end of the market. A lot of the kind of lower end of the market is subsidized by government programs. And so you've got this massive kind of middle market that will drive a lot of the demand of an aging population, and not a lot of solutions right now to fill that need. So we wanted to highlight that observation and that trend particularly as we come out of some of the COVID challenges that the senior living sector experienced, improvement in staffing availability and operational profitability. So that's another area that we're watching closely, just given some of those demographic drivers and shortage of supply, particularly in some of those kind of middle market sectors.
Right. And we have to mention that 2024 has really been marked by serious weather events, not just in the US. What are the immediate and longer term effects of that situation for commercial real estate?
There's no question, as you pointed out, the severity of weather events has become more pronounced. The biggest topic, or two topics that come up in our interviews, and we highlight this in the publication, really relates to insurance, both availability and cost of insurance, as certain geographic locations struggle with repeated extreme weather events. And then the second piece is, how do market participants start to think about their portfolio in the context of some of the locations of severe weather? And do we start to see markets, submarkets, certain types of assets that get tainted because of their prevalence to weather events? And while neither of those topics, the insurance or the kind of redlining locations, has really taken effect yet, it's much more prevalent for the folks that we interviewed, and we think it's going to continue. We do worry about a point in time where certain markets, certain property types are either uninsurable and or they start to get identified as non-investable. And that could really have a trickle-down effect for the industry. At this point, we're not seeing it yet, but it's something that we're watching closely.
Andrew, we've covered lots of different areas in this interview. Any other themes or trends from the report that you'd like to touch on?
I touched on affordability, and there's no question in the U.S. there is a shortage of housing. Interestingly, both presidential candidates discussed the supply of housing and affordable housing as part of their campaigns. As an industry, we haven't had a lot of solutions for solving what is a significant challenge. And part of that relates to local government, local regulations, and the ability for public and private to work together to create new supply. It'll be interesting to see, as we head into 2025 and the new administration, how much of the conversation around housing is focused at the federal level versus the state and local level, because we're going to need both, given the feedback we hear from the folks that we interview and really the lack of progress towards solving this problem to date.
Andrew, really interesting chatting with you today. Thank you so much.
Sarah, thanks for having us.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.